Disclaimer. Trading financial instruments carries risk. This material does not contain investment advice, nor should it be viewed as a personal recommendation, or an offer of, or solicitation to trade in financial instruments. Past performance is not a guide to future results.
Hello everyone and welcome to a new ATFX video. My name is Gonzalo Canete and I'm here to give you again a review of the week. We're gonna take a look of what was the most important events happened during the last 7 days, the last week, and we also gonna observe, I'm saying 7 days because it's not only the 5 active days on the market, but it's also included what happens over the weekends. In the case, for example, of last week, we got during the weekend the G7 meeting in Switzerland in relation with the Ukrainian war and peace agreements and deals. And it was even interesting follow the event because one of the main things it was discussed, it was the sanctions or tariffs on the importations proceeding from China, which in my opinion is open a new window for a trade war, a new trade war. Remember back in a few years ago in Donald Trump administration when they were actually threatening China with new increase on the tariffs on importations from China. In this case, it's exactly the same thing, but it's even going further. European Union announced an increase of 38% on tariffs on specifically on certain importations related with green energies, which means like electrical vehicles, 38%. It's massive. And obviously the answer from China, it was, therefore, China is going to study now and make a research to reconsider the importations coming from Europe. And obviously after that considerations, they probably going to impact on the trade balance of Europe because they obviously going to take another measures against European products. Let me share the screen so I can share with you a few details. I got a lot of tabs open here. We're gonna go through different topics, but regarding this topic, you got here Germany and Slovakia most exposed in Europe to any tariffs. This is the traffic or the trade between China and Europe, and you can see that the most exposed in terms of vehicles, which is what is reflecting this, total imports of cars with engines between 1,500 centimeters to 3,000 centimeters. So you can see that in blue we got, let me take the pen, in blue we got the country which is Germany and Slovakia. So we can see that both countries are the ones who are really exposed from European Union. The third one is United States. And it's not just that, we also got what could be the exposition or which countries are more exposed to the exportations of pork and meat products, and in this case, in the case of European Union, is Spain. We also, I give a few notes about what else could be target, and one of them could be wine exportation, which is mainly France. We also got vehicles, which is Germany and Slovakia, we have seen in Bloomberg charts, and the other one is all products derivative from milk, which is dairy products, which is Denmark and Holland, the main Netherlands, the main countries who could be affected by this. Very interesting topic, and again, it was discussed during the weekend G7 meeting. The resolution was related with this mainly. Now let's take a look to the market. Let's move on certain topics. As I say, I have been saving a part just to explain during this video. So we talk about the tariffs, which is here. Let's also talk about, we got the fixed income bonds, we got the, okay. Today in the evening, one of the most important events, Friday, which it's Friday 21st. By the time you're watching this video, probably is the enter of the week. So I'm saying now in advance, but you wouldn't see now the effects of the expiration of $5.5 trillion in derivatives, options, futures, mainly the merge of all of these expiration contracts for the last 3 months today in the evening in the United States, which is 5.5 trillion of expiration contracts. I can tell you the ratio call over put, which is like bullish positions on options against the shortest positions on options, it's much bigger on long than short, with in a kind of quick fast reading could give us the idea that long positions are stronger than shorts, which is true in terms of derivative, but that was 3 months ago. That's the picture of 3 months ago. Today, with the expiration, we will see what the traders are gonna do. Mainly, they're gonna hold the positions in the way they're doing, or that ratio could actually change, the expectations could change, and we could see how the market is switching. We will see what happens, but if the new roll of the new contracts is actually taking strikes below the current levels, we will actually see that the market is switching from a bullish position to a shorter position. And in my opinion, it could make sense, because if you see closely the market, we are so high right now. And the main reason why we are so high is obviously the tech sector. Nvidia has been doing amazing, but if you remove from this index SP 500 and Nasdaq 100 the technological sector, you will see that actually the markets are not rising that much. I invite you to review Russell 2000, for example, has an index with no technological sector, with no big tech involved, and you will see that we are in a most likely lateral movement. Take a look at this chart and compare this chart, Russell 2000, with the SP 500, and you will see that what is feeding the market right now is mainly 4 or 5 tech companies. In this case, like I say, Nvidia was overpassing Apple, and Microsoft is the biggest company in the world based on market capitalization, more than $3 trillion. And that's why if you go to the real market in United States, the real equity, which is excluding that sector, the market is completely different, a different picture. And not even mention what is going on in Europe. The threat of trade war with China, the European elections we have seen 10 days ago, the future coming in the next weeks, the elections in United Kingdom, the elections in France, with the main threat, same threat in both of them. National parties rising, more conservative. We probably see that in that case means like collaborative positions between governments and European Union are going to be reduced, and that's the main risk. And that's why I believe we have seen how the market is discounted bad moments. So we can see, first of all, how the market is going in a kind of divergence with between the SP and Nasdaq versus Dow Jones 30, Dow Jones Industrial, or even Russell 2000. We can see how that way is splitting. Russell 2000 is not responding. Dow Jones is not responding to that bullish market, and it's only present in SP 500 and Nasdaq. But it's also true that European market is not responding either. And one of the charts I saved here, it was the Asian market. You got on the screen right now. Let me share the full screen so you can see in details all. But this chart is clearly bullish. It's even give us a kind of shoulder, head, shoulder, really not very nice shape on that chart. And it's invite us to believe that if it's dropping below 17,500 points, could cause a massive drop to 16,200 points, which is again a strong drop down on the market. And this is mainly on Seng, which is the continental index from Hong Kong, reflecting obviously that things are not going. The impact on the West countries is not so big, because in 2023 we have seen this index falling, and it was not causing any troubles to US equity and neither to European equity, which is moving usually attached to the US equity, except now. But it's also true that if this index is working in this direction, we have seen in the recent weeks that anytime Chinese government or Central Popular Bank of China is announced any new measure to release pressure on the Chinese economy, this index is responding well. Therefore, if the index is dropping, it means the decisions, the actions taken by the Chinese government to stimulate the economy is not working the way it was expected, because it's discounted by the chart, it's discounted by this market, and therefore we need to be very cautious about this. So very interesting point. Keep on your radar and follow the index for the coming days. What else? We mentioned this. We mentioned also the index. Let's close things. This is another chart I found really interesting. Let me share the whole screen with you too. But in this one, you can see it's an ETF composed by short and middle term bonds in United States. And this is the theory. It's a kind of a trading idea. Considering that it's not this space, these videos are not looking for influence you in any sense in terms of investment, but it's just an idea I was sharing personally with people in my personal profile, which is, if this is the evolution of the fixed income, this is the evolution of the bonds, considering the interest rates hikes during the 2022. Now, if the interest rates finally are getting cut, obviously this market could recover the main levels that it was getting by 2020, 2019, which is a bullish market in terms of bonds. The price of the bond should rise if the interest rates are cutting at the end. So it's also a very interesting point to mention from a fixed income perspective. It's getting interesting because I believe at the end, I have been defending the idea that Federal Reserve is not about to cut interest rates since December 2023. I told you that it was impossible because inflation was still too high. It was 3 point something, moving in zigzag, 1 month 3.2, 3.5, another month dropping to 3.1, moving since June 2023 in that line, around 3%. I was saying it's too early to cut interest rates. They cannot cut interest rates if they follow the manual of economy. But now the things are changing. European Union, Central Bank of Europe has accepted even the spike on inflation in Europe and in Germany. The core inflation is around 3.6%, if I'm not wrong. So even with that inflation, they're cutting interest rates. So in my eyes, they're probably gonna accept that the battle against inflation is over. They lost, and they're gonna cut interest rates anyways, because they got two options: cut interest rates and let the economy keep moving forward, or do not cut the interest rate to hold inflation but get into a recession, which is what's going on in a US economy right now. European economy is completely flat. That's why they are cutting interest rates, because they are not growing at all for more than a year. Since 2022, you can check the numbers. GDP growth is flat or even negative in some cases. They need to cut interest rates regardless the inflation rate. But in the case of US, they are reducing the speed of the economy. We're coming from 2.5% growth rate from Q4 in 2023. Now, Q1 2024, it was giving us 1.6% growth rate. It was reviewed, degraded to 1.3%, so even lower. And I believe, obviously, the Q2 is going to give us probably numbers below 1%, and therefore it's going to be official that the US economy is getting slower, and they need to cut the interest rates to ensure that they keep pushing the economy forward. That was another idea to mention. We also got an important new and interesting one, which was in relation with Japan. It's not this one, although this one is no, it's this one. Norin Chunkin, one of the investment banks from Japan, was selling off 63,000 million of dollars, 63 billions on fixed income bonds. And since then, even the body from Federal Reserve who is monitoring the foreign banks has kept eyes on this bank just to see if they need to intervene or not. As I told you, and I mentioned in some of our previous reports, the main problem here is like Japanese economy is not a threat. I was just saying, even this chart showing like dollar yen is rising to a very risky levels for yen. As you can see, it's almost close again to the maximum registry from April 1990. So we are talking here about more than 30 years ago. It seems that the United States is not so worried about that, and I believe the reason why they are not worried, because one of the things that mentioned by the organisms who follow the foreign banks' activity is like they not perceive a risk. Even Bank of Japan say they are happy with this. I believe from two sides, traders from Japan are on hold because they say, what's the point to try to equilibrate dollar-yen ratio if after all Federal Reserve gonna cut interest rates? They're gonna resolve the problem for us. Because if the Federal Reserve is cutting interest rates, the dollar-yen ratio pair is going to just drop. The exchange rate going to drop to a normal level. So they're going to normalize the exchange rate by the simple actions from Federal Reserve. So Bank of Japan is just playing the cards, saying like, okay, let's hold this situation because maybe at the end there is nothing we need to do from our side. So that's from the Japanese side. From the US side, they don't believe that it's a risky situation here, because they believe that in any case, Bank of Japan will take actions only after communicate with Federal Reserve and discuss the actions to be taken. So it's an allied, it's actually a country who has been under the management of the United States in the Second World War, and therefore there is not a real risk here, or at least that's what we can conclude after the news that we have seen today on Bloomberg. Reuters mentioned that the body who's following the activities of foreign banks is not really concerned about the situation of Japan. But it's still super interesting to see the charts. Let me see the full screen with you. This is amazing, okay? And this is from today. So it's even going farther. 159 yens per dollar. It's amazing. It's amazing. Super interesting. Well, that's all. One of the interesting charts I saw on Bloomberg and I shared on my social networks, it was this one, because you can see the PCE inflation dropping. PCE inflation is the inflation that is measured by the Federal Reserve, so it's more precise, or the favorite one from a Federal Reserve perspective, and it's going below 3%, still 2.75%. I believe the inflation gonna come back, because there is certain indicators that is giving us that perception. I'm talking about the Commodity Research Bureau, the CRB index, which is one of the commodity index which is rising for the last 6 months and going to top records, similar levels achieved in 2022 pre-inflation wave. We also got the cost of overseas trade is rising too in the charts. I shared the chart with you in my social networks time ago, and you can find that too. So therefore, all of these indicators showing us that the prices, the cost of trade, even the energy cost, gas future contracts on Europe are rising as well. So I believe inflation could come back. But so far, this is the situation right now. That's why the market is expecting an interest rate cut, regardless what is going on. Cut the interest rate now, give some gas to the economy, and then we will see what happens in the next 3-6 months if the inflation is back. In terms of geopolitical topics, very interesting. Niger, the country, revoked French company's operative permit at a major uranium mine. France is one of the main countries in Europe who is using nuclear energy, and this is the biggest uranium mine in the world, and they revoke the permission, the authorization that this French company got in the country. Rest of the countries who are in business with Niger still got authorizations to explode and to work in this mine, but including the United States, but not France, which is an important geostrategical point that they are losing right now. Not good days for France, because they are losing many of the business they got in Africa, as you probably have here if you are interested in these topics, with the support of the Wagner troops, the Russian private army, who is supporting military actions in that area. Hezbollah threats war against Cyprus in helps to Israel. This is another news that appears over the week. It seems to be another war starting between Israel and the north border, which is Lebanon. So they fighting the Hezbollah army in the north, and it seems to be again like more serious now. We have seen certain attacks from one side to another of the north border from Israel and Lebanon, but now it seems to be a clear actions, military actions taken by Israel. Israel and Hezbollah face off raises risk of winter conflict, and I was just mentioned here that even United States has been calling for, please, we need to stop the conflict with Gaza, and we need to calm the things down, because obviously it's not good for the region that Hezbollah get involved with Israel in another war. It's another war front open for Israel in the north. If by any chance something goes wrong, Israel can get captured by two sides. So it's very, very interesting point to follow up to. I think that's all. I hope you enjoy this report. I'm trying to bring you the most important topics of the week, and if that's the case, please thumbs up, give me a like on this video, click on subscribe, and also leave me comments if you want I pay special attention to certain topics. Just contact me and I will do I'm gonna follow by the comments. Okay, take care and have a good week, and good luck with the market. Bye bye.